Hi, my name is Matthew, and I work in the Regional and Industry Analysis team at the Reserve Bank of Australia. This video provides a brief summary of current economic conditions as published in our August Statement on Monetary Policy. The global economy continues to recover from the COVID-19 pandemic. This recovery is expected to continue for the next few years. However, the near-term outlook is less certain now than it was a few months ago, because of the spread of the COVID-19 Delta variant. To date, the improvement in economic activity has been quite uneven across various countries, largely because of differences in vaccination rates and health outcomes. We can see the unevenness of the global recovery in this graph, which compares GDP to where it was in December 2019, or pre-COVID. The blue circles show the change to December 2020, and the red triangles the change to June 2021. Where the latest data are not yet available, the chart shows a forecast, and that's the case for Australia. If GDP was the same in June 2021 as it was pre-COVID, then a red triangle would be on the line at zero. Countries like the United States and those to the left of the graph now have GDP above pre-pandemic levels. Looking at the length and direction of the red arrows, we can see that activity has picked up quickly in economies where restrictions have eased following strong vaccination campaigns. For example, the US and UK show substantial increases since December 2020. Elsewhere, including in many emerging economies, a resurgence in the COVID-19 infections and renewed measures to contain the virus have hampered the economic recovery. India is a good example of this, where you can see GDP fell sharply between December 2020 and June 2021. In Australia, a resurgence in community transmissions of the virus has resulted in the reintroduction of strict containment measures and border restrictions in several states. From late June, the New South Wales government reintroduced stay-at-home orders in Sydney and surrounding areas, covering around a quarter of the Australian population. We can see this in the wide green bar on the right of the graph. Shorter lockdowns were also introduced in Victoria, parts of Queensland, Western Australia, South Australia and the Northern Territory over recent months, shown by the thin bars on top of the wide green bar. These restrictions have reduced activity in the community, as we can see in this population mobility graph. Mobility reflects how much people are moving around, including for usual tasks like travelling to work, shopping for groceries, or exercising. In that sense, mobility can be a helpful and timely indicator of economic activity. Mobility in New South Wales, shown in the green line, declined from June as restrictions were progressively tightened in Greater Sydney and surrounding areas, and as people spent more time at home. Recent experience has shown us that activity can bounce back after containment measures are eased and cases of the virus remain low. We've seen this in Victoria, the blue lines, where mobility fell sharply during the 2-week lockdown in May and bounced back quickly once restrictions eased. The recent outbreaks of the Delta variant and accompanying lockdowns will depress economic activity, especially in the September quarter. The dark blue line on this chart shows how GDP has evolved throughout the pandemic, as well as how the RBA expects conditions to evolve over the next few years, or over our forecast horizon. And that's the pink line. Prior to the recent outbreak of COVID-19 in Greater Sydney and other cities, the economy had grown to be around 1% larger than its pre-COVID level. Looking forward, GDP is now expected to decline by 1% in the September quarter, instead of increasing by a similar amount as had been expected before the recent lockdowns. While the near-term outlook is highly uncertain and will largely depend on health outcomes, past experience of these events both in Australia and elsewhere suggests the negative effects on the economy will be temporary. Assuming that recent outbreaks can be brought under control soon and further outbreaks are limited, the transition from recovery to expansion should be back on track by early in 2022. Monetary and fiscal policy settings will support this, alongside significantly higher vaccination rates. Reflecting this, GDP growth is expected to be a little over 4% across 2022 and around 2.5% over 2023. Household consumption has played a key role in the recovery so far and will continue to do so going forward. This reflects that household consumption makes up about half of all spending in the Australian economy. Consumption increased by 1.2% in the March quarter as restrictions were unwound and people could spend more on discretionary services, things like visiting hotels, cafes and restaurants. We expect consumption to contract in the September quarter before recovering in affected areas across December 2021 and March 2022 quarters, assuming no further extended lockdowns are required. Overall, the positive outlook for household income, combined with the recent increases in household wealth, should support consumption across the forecast period. Turning our attention to investment, dwelling investment, which captures money spent on building new houses and apartments, as well as renovations, increased in all states over the first half of 2021, supported by monetary and fiscal policy, including the Home Builder Scheme. Approvals for new houses and alterations and additions, which indicate the level of new activity entering the construction pipeline, have declined recently, but remain well above pre-pandemic levels. Business investment recovered more quickly than expected after falling sharply at the start of the pandemic. Private non-mining business investment increased by 4% in the March quarter, led by strong growth in machinery and equipment investment, particularly in sectors like manufacturing, construction, retail, and agriculture. The labour market has been remarkably resilient throughout the pandemic. Businesses, with the help of government support packages like JobKeeper, have been able to adjust to short-lived disruptions by primarily reducing employees' hours, rather than decreasing the number of staff they employ. In 2020, total hours worked, shown in the orange line, fell by more than employment, shown in the purple line. This means that average hours worked, shown in the green line on the bottom panel, also declined. It's expected that businesses will make a similar adjustment this time around in response to lockdowns, with total hours worked declining by more than employment, as average hours also fall. Some job losses are expected in the near term, but employment is expected to recover quickly as lockdowns are lifted. However, the outlook will depend on the length of lockdowns currently in place. The resilience in employment has also meant that the unemployment rate has declined more quickly than was earlier expected, reaching 4.9% in June. That said, the recent lockdowns are likely to result in a modest increase in the unemployment rate over the September quarter, but the effects on the labour market are expected to be temporary. Consistent with our forecast rebound in activity later this year, the unemployment rate is expected to decline steadily to around 4% by the end of 2023. I'd like to take a moment to discuss the dashed lines on this graph. The statement also explores a plausible upside and downside scenario, given the uncertainties about the outlook. In particular, these scenarios focus on the length and frequency of lockdowns and the speed at which international travel is able to resume. The purple lines in this chart show what unemployment could look like in each of the scenarios. Where the virus is controlled more quickly, economic conditions turn out better and we would expect to follow a path that's closer to the upside scenario. Here the unemployment rate falls below 3.5%. If the spread of the virus means that lockdowns are more extended and widespread, and international travel resumes more slowly, economic conditions turn out worse than expected and we would expect to follow a path that's closer to the downside scenario. As a result, unemployment increases in the near term and remains above 5% between now and the end of 2023. Overall, the recovery in the labour market has been much quicker than first thought. And as unemployment decreases, we expect spare capacity in the labour market to be absorbed, meaning that the unemployment rate will move closer to a rate that is associated with full employment. As this occurs, we expect upwards pressure to build on wages and inflation. Although we have seen a surprisingly strong recovery in jobs and output to date, we have not seen the same unexpected strength in wages and inflation. The Wage Price Index, or WPI, and the red line in this graph, measures changes in wages for workers. The sustained improvement in economic activity and labour market conditions over the forecast period is expected to gradually lift wages growth from its current low levels. The WPI is anticipated to pick up above 2% by the end of 2021, and gradually increase towards 3% by 2023. Turning now to inflation, a useful measure of price pressures in the economy is underlying or trimmed mean inflation. This trims away some of the larger movements in prices. This measure of price growth has stabilised recently at around 1.6%, which is below the RBA's target of 2 to 3%. It will likely remain subdued over the next few quarters given the decline in activity in the second half of 2021 because of the lockdowns. But from mid-2022, we expect inflation to pick up a little more quickly, reaching just over 2% by the end of 2023. Again, this is reflecting an expected tightening of the labour market. So, it will take some time for inflation to be sustainably in the 2 to 3% target range. There are a number of factors that make it likely that the pickup in wages and inflation will be gradual. These include enterprise agreements that set out wage increases for some workers, typically running for a number of years, a business mindset that is very focused on cost control, low inflation expectations, and that it will take some time yet before spare capacity in the economy is fully absorbed. In light of these economic conditions and the outlook, the Reserve Bank Board decided to maintain its current monetary policy settings at its August meeting. The current policy package includes a record low cash rate target and low-cost, long-term funding for the banking system. One change since our last update is that at its July meeting, the board decided to continue buying government bonds after the current bond purchasing program ends in early September. These purchases will be at a rate of $4 billion a week, rather than the current $5 billion per week. And they are expected to last until at least mid-November. Collectively, these measures are working to deliver lower borrowing costs for households, businesses, and governments, contribute to a lower exchange rate than would otherwise be, and support the prices of some assets. The board has stated that it is committed to maintaining highly accommodative monetary conditions to support a return to full employment in Australia, and inflation that's consistent with the target. It will not increase the cash rate until actual inflation is sustainably within the 2 to 3% target range. For this to occur, the labour market will need to be tight enough to generate wages growth that is materially higher than it currently is. The board thinks that this is unlikely to be the case until 2024. Thanks for watching this update. A link to the latest statement on monetary policy can be found below. And feel free to explore our website for more information, including some video explainers about key macroeconomic issues.